Welcome, everyone, to another RLT Pivot podcast. My name is Tracy. I'm one of your co-hosts, and we are so glad you could join us again today. Before we get started, just a reminder that if you find value in what we're doing, please hit that subscribe button, hit that like button, and don't forget to hit the notification bell. Our chat's live, so please throw your comments, questions into the chat bar below, and we will get to them as soon as we possibly can. Dan, the man, what do we got in store?
What is happening? Yes, feels so good to be back. Man, bullish market makes me feel good all the time. So loving it. And not only that, but even better than a bullish market is our guest, RT3, Robert Thompson himself. What's happening, brother?
How's it going? Thrilled to be here. Loving the bullish market as well. Probably more than myself, but I'll take it.
That's hilarious.
Being too humble. But yeah, no, awesome. So we got a topic today, math-based options, pretty much a phrase coined by you. You say kind of sort of, but I think math-based options.
Easy for you to say.
Yeah. Not that time. But so first of all, I want to start with the basics. I want to before we get into a little bit about what you do and stuff like that.
Yeah.
I want to go down because some people might not even realize or understand what an option is. So if we could just go back to just what an option is before we kind of get a little deeper into it.
Yeah, sure. So everybody knows that you can, buy and sell stock, which are, potentially represent an investment in a company. And options are what's kind of known as, to use a fancy term, a derivative of the stock. And so basically an option is a contract that has an expiration date. And that contract gives you the right but not the obligation to potentially acquire shares at a discounted price or sell them at a better price, depending on your timing and how you use it. And options were originally created as insurance for large hedge funds who wanted to take up a large position in one direction, but kind of wanted to set stops without having to sell their positions. So they created option contracts where if the stock went to a certain point, they could get out at that point, depending on what the direction of their trade was. And over the years, we've studied options and realized that there's some very fascinating ways that they move because of the fact that there's an expiration to them. And a lot of people like options because they can give you incredible leverage, incredible risk reward. You can, get 10, 20 to 1 sometimes if you spend a little bit of money and hit a big win. And when we're talking about just like math-based options, it's really just about leveraging the pricing models that are used to create options in the first place.
Gotcha. So are you talking the Greeks?
I am. Yeah, exactly. All those variables that are not part of stock trading. So a stock, you buy it and it's going to go up or down. You got two choices, right? But if you buy an option, the stock could go up or down, but your option price may not necessarily do that right away. It will depend on what you buy, where you buy it, what a lot of different things that are going on. And so there, I didn't really have a name for what I did before. Jeremy was the one who was like, "Oh, you do math-based options." I was like, "Oh, okay. Well, let's roll with that then." And it just kind of stuck. And what I've realized is, there's traders out there who they just make a living on the math-based stuff. So you got your fundamental investors who are poring over the balance sheets and going blind on the quarterly reports and studying the earnings. Then you got your technical traders who are just looking at all the charts and the lines and the indicators. And when a lot of what I do to set up my most consistent option trades happens inside the option chain, working with the Greeks, the theoreticals, and it's actually a lot simpler than it sounds. I know math-based option trading probably scares a lot of people away just by name, but all we're actually really doing is exploiting an edge that exists inside of the pricing models that the exchanges use to create the options in the first place. So they have to predict what a stock's going to do over a certain period of time, and we call that volatility. And then usually the computer models that simulate this stuff, there's 3 or 4 different pricing models that most exchanges use. The computer models that simulate this stuff, they tend to overguess. They tend to overguess, which means that historically speaking, options on average are largely overpriced, and we can capitalize on that edge. That's really what it comes down to.
Gotcha. Gotcha. I mean, the extent of my math-based options, because I'm not an options trader, I would like to be an options trader at some point because I think it's really cool.
Yeah.
But my extent of options is looking at the delta going, okay, well, that's a 70 delta or a 0.70 delta. There's a 70% chance this is gonna, expire in the money. Or
Yep.
a 30 delta, that's a 30% chance that it'll expire in the money. And that's about the extent of my math-based knowledge. So
Well,
how
you're ahead of some right there. I mean, some people I talk to them and it's like, "Oh yeah, what's your Delta?" And they're like, "Huh? Is that an airline?" I fly Southwest actually. And it's just like, okay, we got some work to do.
Okay, that would be a great question for our Hollywood Squares that we're gonna be having in August 5th. So I might have to add that one to our list.
Do
What is
it.
the delta? And if you were on there as one of our Hollywood Squares, you'd be, saying maybe it's an airline.
Yeah.
Yeah.
They gotta trust the math-based guy, right? He's gotta know the answer.
Well,
Exactly, exactly.
speaking of math based, so everybody says options has extra risk to it. They're risky. Don't Some people like don't do it, stay away. With real life trading, as you know, everything is about, it's not how much you could win on a trade, it's how much you could lose on trades. Always protecting that downside. With math based options, how are you able to determine what your risk is, what your R is on any certain trade?
That's a great question, Dan. And that's actually one of the biggest misconceptions that comes into this style of trading because what it tends to be is a lot of selling options. And if you follow the mainstream media at all, which I mean I hope you don't, but if you do, you'll see very quickly that they're trying to steer people away from leverage products. They're trying to steer people away from selling options. Oh, no, 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 no. That's way too risky. You need to leave that to the professionals. And once you really kind of understand how it works a little bit, which doesn't take that long, you apply a little bit of learning. um, there is risk mitigation built into what you do, and I'll give you a classic example. Remember when I said that options were created as insurance contracts for larger positions back in the heyday, and we can look around us and we can easily see that insurance companies are doing okay. They make money, right? So there's definitely some value to operating a business that way. And it's a model where you're going to win a lot. There's a high win rate. But it is a little bit backwards. And this is where people's minds get a little bit bent when it comes to risk mitigation. You are usually risking more on a trade than you can win, and that seems backwards to people. But for in the stock market, for every gimme there's a gotcha. There's no free lunch. Nothing works all the time. So because you have a strategy that wins a lot, when it doesn't work, it's going to lose bigger than you can win, and that is the downside. However, you can develop mechanics and rules to trading these things just like anything else we do here at Real Life Trading. And you can create a system that protects your downside losses. So you know what your risk is going in, you know about what to expect, and you can play management and defense just like any other trading strategy. And I mean, just to directly answer your question, usually when I'm selling options, if I'm selling puts or I'm selling spreads, um, my I like a 1/3 rule, and that means that I'm usually risking two to make one, and that usually means that I'm risking about 3 R's on a trade to make an R, give or take. But
Risking
the,
3R to
the,
make 1R. Okay.
yeah, generally speaking, yeah,
Yep.
and again, the win rate is high, so I'm okay risking a little bit more because I'm not going to lose very often. Now there is some balance to that as well, because you can get carried away with that like anything else. You can go out and you can trade in a way, and I've seen people do this. Sadly, you can trade in a way where you'll win a ton doing what looks like really really easy trades, but then when the moment one of those goes against you, It can blow up a lot of what you won in the past. So as with anything, there are rules, and there are good ways to do it, bad ways to do it. And that's kind of what I try to help people do here in the community, is understand that this doesn't have to be scary. It doesn't have to be only for professionals. Because the great thing about being the insurance company, or being the casino, if you will, you have the odds in your favor. And so it's consistency. You
Mhm.
know, even though the concepts can be a little bit mind bending when you're working through them at first, it's actually a really good strategy, I think, for A, beginners, or maybe B, people who are just kind of struggling with their trading, because it's a great way for you to step in and just stack up wins. It's the classic base hit strategy. You're not going to hit home runs doing math-based option trading. All right. You're not going to take 20 grand and turn it into 100 grand in a month. That would be ridiculous. You would have to take on so much risk to do that, that it would be completely unsafe. But you will stack up base hits. You'll stack that wood. You'll clock wins left and right. One of them might go against you a little bit, but you play some smart defense, limit your losses a little bit, and you just keep on trucking. And so I do have other strategies, if I want to, that I can use to go and hit home runs on. But this is just a nice, steady, in the background, lock gains in, number go up type of
So
approach.
with options, and it's tough now to explain because we're not using charts or examples or something like that. But what would be something that you look for, and what would like a typical setup be, or if you have a example of one you did recently or something like that, just to
Yeah,
help get more
I can
specific.
actually give you an example of one that we looked at in my mentor group just a couple days ago. So the number one thing I look for when I'm trading options this way is good volatility. And I'm actually going to try to do a video about this too, but there's some confusion out there in what is good and bad volatility. And not to go too deep in the weeds, but the IV index that is on most option chains, that's only one piece of the puzzle, because that's only going to benchmark the options of that ticker against the SPY. What you need to do is you actually need to benchmark the options of that ticker to itself. I'll give you a classic example I've been using lately. Do you think that the volatility on GameStop is high or low right now? Think.
Couldn't
GameStop probably pretty high.
Yeah, I mean, relative to the SPY, yeah, I would say it's really high. Relative to itself, though, it's actually at one of the lowest points it's been in the last year. So if you're selling options on GameStop and you're trying to capitalize on volatility, you're actually on the wrong side of that trade right now. Now, again, we don't know what's going to happen in the future. Maybe GameStop's heydays are behind it and it'll start calming down, you know. But for now, when you compare GameStop to GameStop's own volatility, um, it's actually at one of the lowest points it's been in the year. And I use IV rank and IV percentile to gauge my volatility for option trading. And those are free. You can find those on barchart.com. You just type in a ticker and go to the options overview. You can see both IV rank and IV percentile there. A lot of brokers have those numbers in different places. And so typically I like to sell volatility when it's over 30 on an IV rank scale.
really.
And so we did one. Yeah, exactly. We did one in my mentor group the other day on NVIDIA right now, right after the split. So I didn't want to get in front of that thing when it was getting ready to split. But right after the split, there was a nice little volatility spike. And I typically go about a month and a half to 2 months out. And that is, I didn't invent that number, but that number does work. It has been researched by MIT think tank geniuses, much smarter than me. I'm not an MIT think tank genius, by the way.
I've never met anyone smarter than you, so
Oh
I'm gonna
my
have to.
gosh, that's funny. My point, though, is you don't have to be an MIT think tank genius. We're going to give you the structure, and we're going to give you the research backed techniques that work. So I go about a month and a half, 2 months out. I usually stick to monthly cycles because when you're trading options in a math based way, sometimes there's adjustments you make. And this is another mindset shift to this style of trading that a lot of people kind of don't realize is there. And that is that I tend to look at my option trading oftentimes as more of position trades, where I'm getting in and I'm kind of hedging around them a little bit and I'm working them through to fruition at the end. It's not just a once in, once out trade over. And so because of that, that informs some of the mechanics and the metrics that I use. And especially when you start trading spreads, you've got multiple legs and you're going in and maybe going out again and maybe coming back in again and maybe hedging on the other side. Sounds like a lot, but once you get used to the kind of the thought process of it, it's not as bad as it sounds. My point though is you got to have liquidity.
Mhm.
So I'm usually only trading mid to large caps with lots of volume on the option chain because I don't want to get chopped up on multiple bid-ask spreads. So when I'm looking for a good trade, I'm looking for high volatility based on an IV rank scale. I'm looking for 1.5 to 2 months out. And then I'm usually selling options if I can be. If volatility is really low, but I love the trade and I think this thing's going to the moon and I got to get in, then maybe I'll do like a debit spread. But usually credit spreads are like my number one go-to. And that's put credit spreads. So you sell one contract and then buy another one further out out of the money, which is kind of like insuring your own position. So you become your own insurance company. And those are just one of the many ways that we can mitigate risk and we can participate. Like, if you do a $5 wide credit spread the way that I teach, your maximum loss on that trade is about $300. So
Hmm.
that's pretty manageable for most people. Like anybody can do this. You can
Okay,
get in there and get started.
so let's talk about that for a second because first of all, I want to mention that I encourage my newer traders to stay away from options, and the one reason that I do that is because most of them don't know how to control the risk. That's
Yeah,
the primary reason. Otherwise, I'm all for it, right?
right.
Second thing, we do have a comment in our chat that wants to know where they sign up, so we'll get to that shortly. But the next thing is, you mentioned earlier that you can't turn a $20,000 account into $100,000 in a month. But
Right.
what kind of an account expectation would you expect for
Sure.
growth?
Okay, that's a great question. So I have been doing this for several years, and I've seen some varied results. But I'll just give you an example for last year. Last year was kind of the Mount Everest of trading. For any of you who are professional traders, if you traded through COVID and you survived, give yourself a pat on the back because that was expert level trading that you needed to navigate that market. And if a strategy was extremely risky and unreasonable, it should have gotten completely destroyed in that market. And one of the IRAs where I just keep it very simple, very straightforward, and just do math-based options and nothing else. Just kind of log into it once or twice a week. Keep it kind of low key. It's just kind of humming along in the background. Um, that account saw about a 35 to 40% gain last year, just doing math-based options. So I'm not doubling my account every year with these strategies, but I am beating market returns pretty consistently. And I win a lot of my trades, and then I defend the ones that I don't win. I almost never take maximum loss on my trades. So it has become, for me, it has become a foundation that I can build on. Jeremy always talks about being a specialist, not a generalist in the market. And that one has been my go-to for when I just need to kind of relax and make some money. And then I try other things in the laboratory. I'm a trader just like the rest of us. And I go after the shinies every now and then, and I do back trades and I try different things and I try different strategies. I mean, I trade a little Momo every now and then. I mean, why not? I want to hit some home runs too. But the math-based option stuff has been there for me as a just carry the day, stack the gains type of strategy.
All right. So, what size of an account would you recommend to trade this? What would be the minimum size?
All right, so I've done it in an account as small as about $1,500. You can do one spread contract, but you're going to risk more there than you would normally on any other size account because I mentioned if you have a $5 wide spread and you take max loss on it, which I rarely ever do, but it is a possibility. That I'm not trying to hide from people here. You're going to lose 300 of that 1,500, right? But again, because of the high win rate, you can usually overcome that pretty well. The optimal starting place, in my opinion, based on my rule of using about 3 to 5% of your account per trade, would be about 10 grand.
Okay.
Because if you do a $5 wide spread and your maximum loss is 3 to 350, That's roughly 3.5% of a $10,000 account. So I think that is like the optimal place to start, but you don't have to have that much. You can probably do it with 5 grand, I would say would be a good starting point. If you're going to start lower than that, you need to practice a lot and and really know what you're doing. Because if you make a couple of bad mistakes, you're gonna be out of luck. But once you learn this stuff, you don't need much to get the ball rolling.
Gotcha.
How important is charting when dealing with options, math based options? I can't say that for some reason. I don't know how you say it so fluent.
Math-based offense. Yeah, that's a great question. It is actually here's what I tell my students. It is entirely up to you. Math-based options assumes two things when you come to the table. It assumes you've picked a stock and you've picked a direction. And you can do that in any way you want to. If you want to rely on fundamental analysis and you see a great earnings report and you want to be a part of it, set up a math-based option trade. It becomes a tool in your toolbox that you can apply to any chart setup you want to, honestly, as long as the other math-based metrics are there. However, I will say, I've met traders at shows and I've corresponded with some friends of mine who they don't look at any fundamentals. They don't look at any charts. I mean, they might glance to make sure they're not buying the top. But outside of that, all they look for is the edge inside of the volatility and the price action and the extrinsic value and the theta. They set up neutral strategies where you don't have to pick a direction and they just wake up every day and let the sun rise. And as long as that happens, they're probably making money.
Wow. That's awesome.
It's pretty amazing.
No, that's awesome. So how do people sign up for you? Because you're a mentor at Real Life Trading, right? And you have mentor groups.
Yeah, absolutely. So my August one just sold out, unfortunately, but check around for the September one. If you are a member of the community, just shoot me a message and I can put you on the waiting list. My email is robert3@reallifetrading.com if you want to get a conversation started and just see if maybe I'm a good fit for you or not. And then I have a coaching link on the Real Life Trading page as well. So you can hit me up in Slack, you can hit me up by email, sign up for one-on-one, do the mentor group. All of those are ways that you can access kind of what I do and how I'm doing it.
Now, one other question I have, you mentioned an IRA. Now,
Yeah.
do your strategies require selling puts?
They don't require it. They can work better doing it, but they do not require it at all now. So here's what's interesting. If I'm a big Tastyworks fan personally, if you use Tastyworks, you can actually do anything in their IRAs, even sell calls if you wanted to, if you just wanted to go right off the deep end. But it's going to use a lot of buy power in an IRA, right? So a lot of my IRA traders, we do spreads. We do credit spreads and debit spreads. And there's actually really creative ways to where you can synthesize the effects of a naked put with wider spreads without going too deep into the weeds. We actually have a name for those trades. We call them synthetic naked puts, where it caps the buy power in an IRA. So you don't have to do the cash secured put thing. However, a lot of the big brokers will let you sell puts in an IRA, but it's going to take up a healthy chunk of your buy power to do it.
Yeah, mine doesn't. That's why I'm asking it. But I don't have an IRA. I'm in Canada, so I have it's called a locked-in retirement. I've got a Lira.
Got it.
I can sell calls and I can buy puts and buy calls, but I can't sell puts. So,
So are you able to sell put spreads where you sell a put and then buy another put out of it?
I have to look into that. I don't believe so. I've never tried, so I'm not sure.
Yeah, the put credit spread is kind of like my bread and butter strategy. I trade that more than anything else.
Okay.
But even if that were not an option, there might be other things that you could come up with that would potentially work.
Perfect. Now we have another question here from Alex. He says, how do you adjust a credit spread when your short leg falls in the money?
There's two ways to do that. So this is all based on research that I've studied. And it comes down to basically whether or not you want to roll out in time. And this is where I tend to think of option trading as more position trading. Some people don't like rolling options. And so what I'm talking about basically is picking the whole spread up and moving it out in time, because when you kick the can further down the road, you're taking on more time risk, but you're going to get paid for that. So you can take in a credit to roll your spread forward in time. Now, you've got to have good mechanics, and you got to have good rules, and you got to have a method for tracking your cost basis. The reason I like doing that is because it allows me to steadily improve my cost basis over time. Now, in your broker, you're going to close a trade and open a new one. I get that. But this is why I track it like a position trade. If I sell a $1.65 spread and it's $5 wide, and I roll that out in time and I get 5 or 10 cents of credit for it, I have a new $5 wide spread. But if I combine the credits that I've received for it, I actually sold it for more cumulatively than when I started. And so I'm step by step, I'm selling my spread for more and more and more and more, which improves my profit targets, improve my cost basis. And the reason this works so well with spreads, guys, spreads are capped. They're defined risk. A $5 wide spread will never be worth more than $5. So if you are steadily improving your cost basis, you are also at the very same time reducing the maximum amount of loss that you can possibly take on the trade. And you just roll it as you need to. Now, there usually does come a point if the stock's just trucking right through your spread and there's nothing's going to stop it, where you're going to have to wave the white flag. And the other defense mechanism in that situation that I use is just managing my spread early by closing it. I don't hold spreads to expiration, which is another thing that kind of sets me apart. So if a lot of option traders, they'll sell options out of the money and just try to hold it to expiration. But there's other Greeks at play there that can really create some dangerous risk that you may not be aware of. And so by avoiding the last few weeks of the option cycle, I am usually able to effectively hedge my losses, if you will, and just redeploy capital at that point if I have to. So those are the two methods I use to defend credit spreads. I either roll them out for a credit. I don't ever roll for a debit. That's adding money to a losing trade. That's no bueno. There's no such thing as dollar cost averaging in credit spread trading. So I don't do that, but I do. I will roll for a credit, or I will just go ahead and close it early. And I have specific timings and metrics for that have been, again, researched by MIT geniuses on another plane of existence.
That's so
We
cool.
did have one other question that came in from Ernest.
Yeah.
He's asking, any recommended reading for understanding how to avoid taking massive loss?
Oh boy. So there's some good, that's a good question. Recommended reading for how to avoid taking massive loss. When we're I don't know of anything that implies specifically to math-based trading. I mean, I can point you to some resources where I got a lot of my information on math-based trading. The easiest place to go would be either to our YouTube channel or our Slack channel, or potentially if you're looking for another, like a specifically math-based focused resource, I would recommend Tasty Trade. Just watch some of their videos and you'll start to get the idea. In terms of reading, though, there's some really good books that I've read that help me understand the business of trading, which, as you two probably know, revolves around risk management quite a bit. And so it really just comes down to having a plan. This is my plan. I'm getting in for this reason. I'm going to get out for this reason. And if it goes against me, I'm going to define a loss as looking like XYZ. And when that happens, I'm going to get out for that reason at that time. And some books that really helped me think that way and operate that way and kind of create the plans that I use in my option trading. Number one would be Trading in the Zone by Mark Douglas. Just a phenomenal book on trader psychology. And then the second book that I read that I really enjoyed was Dr. Alexander Elder's The New Trading for a Living. Now, he is a technical trader, so a lot of his book is like technical analysis, its history, how it works, its strategies. But the first 2 chapters of that book are all about the psychology of being a professional trader. And those 2 chapters alone are worth the price of that book, in my opinion.
What was the name of that one again?
That's called The New Trading for a Living by Dr. Alexander Elder.
New Trading for a Living.
Yeah,
Sounds good. I'm going to add that to my list.
do it. It's
Yeah.
an awesome book.
That's awesome. Well, Robert, it has been a blast having you on the show. Unfortunately, 30 minutes has gone by. So,
Oh my
Dan,
goodness, look at that.
you've got some announcements, Dan, do you?
It's too quick. Well, number one, obviously we only have roughly 30 minutes for this podcast, but you can go to reallifetrading.com if you do want to take full in detail course. I believe you have your course on there as well, which gives a lot more time, a lot more detail, and more specifics on everything as well. So you guys can check that out as well. We do have the game show that we are doing, the Real Life Trading game show here on the Pivot Podcast. That's going to be August 5th. We're still looking for the contestants, and there is rules. If you go to reallifetrading.com, you'll be able to see, just click on the little link for Pivot Podcast. Once you get to that homepage, you'll see all the details of how to qualify to become a contestant on that show.
Deadline next week. Deadline's next week. So next Wednesday, we have to have those submissions in. Otherwise, it's a no bueno.
That's coming very quickly. So make sure you guys get your submissions in for that. And no. We need to hit that smash that like button for me. If you guys enjoyed the Pivot Podcast today, make sure you guys do also hit the subscribe, get all the cool notifications, ring that little bell. I'm not sure what that does, but make sure you guys take care of business on that. And Robert Thompson, always a pleasure having you on, speaking to you and learning some really cool stuff. And I still think you're probably the smartest guy I've ever talked to in my life. So
I appreciate being here. Thanks, you guys. It's been fun.
Thank you guys for joining us.
Fast.
See all of you guys on the next Pivot Podcast. See you guys later.
Later.